Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com. Now over to your host, Sparta co-founder and CEO, Felipe Elink Schuurman.
Welcome, everyone, to another episode of Sparta Market Outlook. I'm here today with our special besties or friends from the Sparta team. James, hi, how are you?
Very well, thanks. Yourself?
Very good, very good. Jorge, all
Hi,
the way from
Felipe.
Madrid. How are you?
All very good, all very good.
Excellent. And last but not least, our good friend from Scotland. How are you, Neil?
All good, thanks, yeah.
The most Austrian Scottish or the most Scottish Austrian in the market. How everything okay?
In the tiny market, yeah.
Exactly, yeah. Well, you're definitely, you secured that niche. You're very good at that.
Yeah.
So before we talk about the docket and what's going on in the market right now, and obviously there's a lot of things to talk about. I was lucky enough to be at the FT Global Commodity Summit for the last 2 days, and very interesting conversations. And I thought maybe I would summarize a little bit what the main trends and topics were discussed. I know we had amazing panelists and thought leaders and C-suite like CEOs, Torbjörn, Richard Holtum from Trafi, Torbjörn from Gunvor, Marco Dunant from Mercuria, Vitol CEO, what's his name, Russell Hardy. So you had people like that. You had Ben Lucock, you had Jeff Curry. So it's Jeff Curry, Steve Curry. I always confuse the two of them. Which one is the one that plays basketball? The other one that knows everything about geopolitics?
Basketball.
Exactly. So that's the one. So no, that's not the one. It's the other guy. So Jeff Curry.
Indeed.
So fascinating talks. So let's summarize a bit what was discussed. The first thing is that the main topic, of course, Trump. Now, Trump is number one topic and all that, but there's not really much to say other than there's a lot going on. But I think that one of the topics that surprised me the most, it was, obviously we're back to this realpolitik. We're back to talking so much about sustainability, but the energy transition discussion is absolutely still there, and it's a very important topic. And no one is debating it. No one is sort of, oh, no, this is a perfect time to go back to oil. That's not the point. It was more around what are the priorities of this energy transition and how do we get there? So historically, it was all about, sustainability, renewables, etc., for the sake of sustainability and climate change, etc. Now, main topic is energy security. The second one is affordability. And then the third one now, only at the bottom of it, is sustainability. So that's changed quite a lot. And you could see that in some cases, it was almost vindictive. Like, I've been shutting up for the last 5 years, and now finally I can speak up without being booed, like, oh, you're an evil person. You don't think about the planet, And there was a little bit of a vindictive side. But and there was also other people that were saying, "Oh, I've been saying this all along." The famous "I told you so" guys. You always find those guys. But it was definitely the main topic, energy security, which is quite interesting because you have guys like Ben Lucock who was saying, everyone is talking about European refineries that will shut down eventually at some point and all that. But then in this transition, do you really want to subcontract your refining to Saudi, to Kuwait, to Nigeria, to US? It's a good question, and, he was stating the example of Australia that suddenly now doesn't have any refinery. And therefore, in this multipolar world that we live in, do you want to depend on your energy from external sources? And it's a question, which then leads to a more fundamental discussion going forward, which is, will we find ourselves in a situation where we are not optimized and where you have overcapacity just for the sake of security, And it's completely the opposite of what we've been taught. And, we've been for the last 80 years, everything has been about optimization, globalization, bringing down costs, going arbitrage from the cheapest source to the best. And actually, that's what we do at Sparta. We try to deliver that optimization. But if we end up in a multipolar world where you need to have an oversupply just for security reasons, and again, U.S. talks about energy dominance. It's dominance. It's a strong word. And so Jeff Curry, I'm constantly thinking about Steph Curry. So Jeff Curry, we kept saying that interestingly, he mentioned something. He said that we are no longer talking about peak oil in terms of we're running out of oil. We're not talking about peak oil in terms of where the demand is disappearing and everything's going to be switching to gas or renewables and all that. But he basically said we've reached peak trade, which is an interesting concept, meaning that, again, going back to this energy security where everyone is producing locally, and therefore that optimization, global optimization, is no longer there, or it will diminish over time because of a more polarized world and more locally produced, security. And he was basically making the point that you are going to get to much better sustainability numbers because of energy security. So in essence, because let's take the example of Europe, if you want to be self-sufficient in terms of energy, well, the best way is not to rely on oil or gas. And to essentially have everything nuclear and renewable. Now, of course, you don't do that immediately. It takes maybe 30 years to get there or whatever it takes. But in the meantime, what you're seeing is then on a gas perspective, two main suppliers are now a partner that you cannot really trust that much and an enemy that actually needs you more than your partner. Because again, Russia is or maintaining their exports of oil, and we haven't really seen the problem, but they don't have this ability to export gas. They really need Europe, so that their relationship there is of hate and need and love at the same time. So anyway, it's a very mixed kind of summary, but energy security being one, Trump. The other thing interesting was around tariffs. General consensus from what I heard, and this was, I think, mostly Torbjörn from Gunvor, is like they won't really have a big impact in the market. The tariffs is a lot of noise, but when you think about the facts, it's not that big. And maybe you guys have a different opinion, but that was, well, and again, I don't want to put words in his mouth. Maybe he didn't really say that, but that's what I understood, is that they won't have that big of an impact. Sanctions, on the other hand, of course, they do. With this, very interesting discussion around Russia, I think the consensus was that we're heading towards that stabilization of relationships over the next 1 or 2 years. Is it a good deal or a bad deal? I don't know, but it's going to be a deal that, sort of brings Russian barrels, particularly gas, because oil, as I think we all agree, it's already there. We haven't lost those barrels, but it's mostly the gas that we've lost. So that could have a big impact on gas.
No, it's interesting on the energy security piece, because actually the last 3 years has kind of been like a bit of a case study on it, really, right? So we've had like the shocks created in like the energy markets by the Ukraine war, by the war in the Middle East. Like we've spoken about it, I think, at length, like sanctions on Russia in the past and currently even, and Cape routing for vessels, for example. And it's really kind of contributed to kind of the big inflationary shock that we've seen in like European markets, for example, in the US as well. And when you look at like the politics, no real incumbent political party has survived that, right? So it's really kind of like a lot of incentive for them to become more energy secure. It's and not have those inflationary shocks that we've seen over the last few years.
I think the big change is the fact that suddenly your closest partner is essentially saying, hey, the rules of engagement since World War II are no longer there, or we don't agree with them. And as I was reading somewhere, I don't know, a lot of people say, yeah, but Trump is gone in 4 years' time, and then we're going to have Democrats or another Republican, and we will have more normalized relationships again. But when you look at the way that J.D. Vance talks, there is a sort of a followers. It's more than just a person. There's an idea behind this. There is this idea that we are no longer the world's police. We need to focus on ourselves. We need to be a bit more selfish. Why should we be defending all these people? And again, it's very, I can understand the concept. I fully agree that they have every right to think like that, but it's too simplistic to suddenly, not to give the context of why they were doing that. Let's not forget that they told the Ukrainians that to let go of all their nuclear, their stock, because they would be defended, or it was the accords that we had post World War. It was that U.S. would defend everyone, and in exchange would have a sort of dominance over everyone else as well. But anyway, it's that I think that's the biggest problem. That's the big shift. Is that even if Trump leaves, there are many other people that have the same ideals.
Interesting.
Yeah, it's a good question on energy security. I mean, one question, because you sort of pinged us yesterday to talk about it, and one question in my mind that popped up was to say, when you actually really secure, and you sort of alluded to it before, so the one thing is refining, right? And the other thing is the feedstock for your refineries. So that's the thing that I always have a bit of beef with when there's kind of, let's say, activism about oil majors' upstream business, because then you cede upstream supply to other partners who might be less stable, let's say, to put it in a very politically friendly terms. And then, as you just alluded to, that the actual way to secure your energy supply is to go to renewables and try and, run things on EVs instead of oil. And even then, you're probably at the whim of EV makers. So you have to start to make your own EVs if you want to go down that far, down that route.
Absolutely. Yeah. Which again, if you extrapolate everything that we just said right now, and it goes back to this idea that everything that we've been doing until now has been a globalized efficiency, a race towards efficiency on a global scale. And now we're sort of saying, well, do we really want to do that? And we're second guessing that premise and saying maybe having a global optimized spreadsheet is not necessarily what you want. You first need to think about security, and then once that security is attained, then you start optimizing. But so what does that mean? You're going to have, and I think that this was Russell Hardy saying everything everywhere all the time, so meaning that it's not power or gas or oil or coal, it's all of them. It's EVs, it's gasoline cars, it's nat gas, it's
biofuels.
Biofuels, you need everything, Yeah. So
and that's a reduced kind of risk profile if you have kind of energy, if you're relying on various sources instead of basically one. Yeah.
But let's face it, this costs a lot of money. Why do we go towards efficiency? It's because we want to spend, right now, energy represents, I don't know, frankly speaking, I don't know, but probably something around 5% of our consumption. When you look at your overall bills, it's maybe 5-10%, I don't know. And so we're taking for granted it's something that's free, almost free. And so that you can spend more money on having Netflix and Disney and, because one of them is not enough. You need 3 or 4. And the same thing with Amazon and all these things. That's basically where you spend your money today. But the problem is that if that energy becomes expensive and you need the capex and all that, then suddenly we don't have money to spend on other things. So it's easy to say energy security, but can we actually sustain that? So this is my personal view. I think that right now that's the topic of discussion, but I think that ultimately Europe will start defending itself and have this army and all that. But will we get to a situation where every single region is self-sufficient energetically? That's so expensive. You cannot spend all the money in energy security and all the money in defense and on welfare, welfare state. Something's got to give.
And a huge cultural change as well, like building back up a manufacturing base, switching the society from less finance focused to like more manufacturing.
Absolutely.
It's a huge change.
Huge. Someone has to pay that, and I'm not sure that we will get there. And at least in Europe, as soon as we start getting divided, boom, the whole thing collapses. So right now, everything, the enemy, or like the pride against the U.S. is so strong that everyone is sort of like united. It's like everyone. We're having these multi discussions, and every week we have a new meeting in London, in Paris, and in Kiev or whatever. But once once we start getting the bill as consumers, then let's see if we remain united or not. Anyway. So what I'm trying to say is that, this year everything's about energy security. Next year is about who's going to be paying the bill. That's my point. And do we want to continue being in energy security? I mean, look, who am I to say all this? That's just my 2 cents worth. Anyway, so it was great. Frankly speaking, I really enjoyed it. It's a phenomenal conference. Bloody expensive, but it's a very good conference. And you get to hear all these phenomenal people. By the way, as a segue into our discussions, bringing down to earth, there was a panel on oil, and one of the interestingly, everyone, you ask, FT as a journalist, hey, where's going to be the flat price? Like crystal ball kind of question. Everyone sort of more or less answered that yes, the market is slightly oversupplied, and maybe we end up around the high 60s or something like that. But what was very interesting is that there were a lot of comments like Fred Lasserre from Ganvor or Ben Lucock from Trafi, essentially saying, well, stocks are not that high. They're not huge. The story is that, we're oversupplied and this and that, but the stocks are not that high. And Ben Lucock made an interesting argument saying, well, look, I think that the flat price is so low right now. You are now entering into, summer demand period, etc. You might as well find a situation where cracks actually go up, not because of a depressed crude market, but actually because of a higher demand on products. So he was fairly optimistic of a little bull story there on the summer products on gasoline, diesel. So that's just a last comment on the FT, so that we can move on into what's happening in the market right now. What can we start with? Neil, you want to start with Venezuela tariffs?
Yeah, let's go quick fire through the stuff, I suppose. So that adds on to what you were saying about whether tariffs or sanctions make the biggest difference. Well, this week we got a kind of hint that tariffs are being used as a type of sanction, if you like.
Yeah,
so
it's a new hybrid.
It's a new hybrid. So I suppose everyone's seen the news, but whoever imports Venezuelan oil will risk a 25% tariff on all trade, seemingly. And it's up to the discretion of the Trump administration whether that happens. And
has this ever happened in the past? I think it's the first time I ever hear about something like this, no?
I can't say definitively, but I can't remember reading about this before.
It's very convoluted. Yeah. I mean, it's like it's max pressure, it's on Venezuela. It's not direct, it's indirect, and at the discretion of one person, essentially. Not the most reliable person in the world.
and there's no real word about A, whether it's going to happen, B, how it's going to be measured, because in this is really against Venezuela, and it's also against China, because China's the biggest importer, right? So under what circumstances will they be proving this thing? Will it be official documents, because China imports from Malaysia, various kind of blended barrels, if you like, in the official stats. But, the writing is on the wall. And they also sanctioned a Chinese teapot last week for importing Iranian oil. So I think the direction is very clear. The US administration understands what's happening and they want to put more pressure on. Okay, that's quite obvious. And to me, it means, what is the Chinese response? Because we've talked about sanctions for months now, and we've always said, well, it's going to require the main buyers to unilaterally say, okay, now we stop buying. And maybe this is one of the ways of doing it, because the risk reward for China is very poor. It's 500,000 barrels a day Venezuelan versus what, in theory, on paper just now, is another 25% tariff on all trade between US and China. Is it on all
trade?
I think that's what it is. Yeah.
I thought it was on energy, like derivative products. Like if you buy crude from China, you're going to not buy crude just for the sake of it. You're going to refine it. And anything that you export then would be sanctioned. Okay.
I think it's all trade.
Actually, then I fully agree. So, this is all about China, nothing to do with Venezuela or Iran. It's like, you cannot buy cheap oil, essentially. Yeah.
Well, a bit of both, and maybe more pressure on the Maduro to get whatever concessions Trump is looking for on things like immigration. No idea what the what the plan is there, but
smart, smart, I have to say.
Well, it's definitely a new direction, right? It's a new signal on the sanctions front, and it's officially a tariff, but it's a sanction. So yeah, it's maybe 500,000 barrels a day. It's not much for China can get over that, but it's important for the crude market, right? Because no one else is going to buy this oil if it pans out this way, and that's a very bullish thing, right? And today there were headlines, Reliance, the other importers are kind of Reliance and I think Repsol. And Reliance said today they would pause buying, and Repsol is considering switching, right? So it's making an impact already on these guys.
Interesting.
Yeah.
So that's very interesting, because obviously in all this sort of situation, the two guys that have benefited the most are obviously India and China. But as we've discussed many times, India is now in this perfect position where they're everybody's buddy, and no one is saying anything against India. And so far they've been saying, you know what, screw it, we're going to buy Russian, we're going to buy whatever we want. But this here is the first time where actually they cannot just say whatever, I do whatever I want. It's like, yeah, you do whatever you want, but then you cannot export anything to the US. It's an interesting, it's first time I see this, that India will actually be affected.
Yeah, and I mean, India is a very small buyer of Venezuela, but I think the takeaway is, right, what if they start doing this on Iranian volumes and
Absolutely,
potentially Russian volumes? Well, okay, let's not go down that kind of worms, but certainly Iranian volumes. And the US rhetoric on Iran has gotten a lot more hawkish just over the last few days as well.
Yeah.
So I'm not surprised that flat prices back up to $74 today, actually. And then on a very, very kind of quick basis, we'll get onto it later, but it's probably bullish. Distillate cracks is probably bullish margins if it turns out the way we are thinking, because Shandong relies on this stuff. They won't necessarily have the quotas to import something else. They lose access to cheap feed. All else equal, it seems like teapots will be under pressure. So that's good for the distillate market. It's good for the global product market, and it's probably bullish sour crude and the EFS as well. But we can talk about that later.
Mm-hmm. So the other thing is, as an ex-physical trader, and every time there is a new, let's say, political rule, there's always someone trying to figure out a workaround. That has been. I'm not saying, I mean everything legally, of course, but I'm just saying there's always a workaround. Do you think there's going to be any kind of workaround here or not?
Well, that's what I'm trying to think about. I'm trying to really try to view it from both sides, because traditionally you talk about sanctions and stuff like that, and there's always a workaround. You blend something away. There's a million names for Iranian and Venezuelan crude on the market, on official documents and stuff like that. Malaysian blend and all kinds of stuff. But the point is, if it's a real threat about global trade, then maybe the Chinese government steps in and says, no more, actually, this is not worth it for us anymore. And yeah, that's kind of what I'm trying to say. Of course, I don't know, but this is just the feeling I have in terms of it's actually a change in direction there.
Yeah, I guess that, when you are like Russia and you have such a significant market share, you're too big of a problem. You cannot just say, hey, you're out of the system. But Venezuela represents how much exports? What is the size of the...
It's like 800 to 1 million. Yeah.
Which is precisely the oversupply for this year. Maybe that sounds perfect.
Well, the timing is maybe not coincidental on multiple angles. And sorry to go on a rant here, but I guess you could say that Trump, the sort of Canada-Mexico tariff situation didn't go that well for Trump, all told. And so now he looks a bit, there's a new target where it's probably an easier target because Venezuela is not a trading partner, right? And then he's probably talking to OPEC, let's say. He might be talking to Russia. And just to make a note, reportedly Russian crude exports are pretty high at the moment. They've risen quite a lot the last few weeks. So could be coincidental. It might be refinery maintenance and things like that. But maybe the timing is not coincidental, right? So you never know. There's potentially all kinds of back chatter going on, or backroom chats.
Interesting. Yeah. And what about, you guys were talking about this April 2nd Liberation Day. What does that mean? I don't even know what that is.
Liberation Day is what Trump is calling it's a new name, I suppose, for the day in which US and global trade will be remade. So that's the target for all of these new tariffs. Yeah.
Amazing.
God, these guys. Seriously, they got a name for it, Liberation Day? Jesus Christ.
Yeah. So
They're very good at marketing, I have to admit.
That's when we get to find out, right? So we're this is the last pod that we can do before then and release, and it was just to note where do we think things are going, and we're asking internally as well because we're trying to track this thing for our clients. And my feeling is from the press releases and stuff that probably the Canada-Mexico energy tariffs are not going to go ahead, because there's a lot of talk about sector-specific tariffs on steel and auto industry and things like that as a new kind of way of going forward here. So I think the energy stuff isn't going to happen. And if you look at certain things like the WCS, the Canadian diffs at Hardisty, they're not telling you anything about tariffs at the moment. They're really, really strong, potentially for a few reasons. But the market doesn't seem to be thinking that these energy tariffs are going through either.
Yeah. But again, it makes sense, this whole idea of I threaten with max pressure so that you can come to the negotiating table with a bit wounded before even starting the negotiation, and then I have a better deal. I agree with you. I think that it makes sense. Everyone says this guy is like erratic and crazy and all that, but if you actually just remove the tone of voice and you just focus on the content, he has a very clear strategy of how he wants to get about it. And it's about, I want to negotiate a better deal, and I'm going to start with something completely crazy that is going to rattle you so that we now have a discussion in my terms, So look, again, it's maybe possible that he doesn't do it, but I agree with you. I would not be surprised that the situations where you shoot yourself in the foot are excluded from the conversation.
Yeah.
Before we move to the individual products discussion, anything else to add? Maybe Russia, Ukraine before the latest update, or
1 minute on it. So there's the ceasefire being talked about now in the Black Sea, and also on energy infrastructure, which I suppose is kind of bearish for diesel and naphtha. You guys can talk about that if you like, because obviously the last few weeks have been massive round of attacks on Russian refineries. But what else can you say about it, right? It's the situation is very fluid. You don't know when this agreement will happen. I think Russia drone attacked a Ukrainian port last night, so that's not a very good sign. And Putin wants all kinds of concessions in exchange for this thing as well. So, and diesel cracks didn't respond today, so I suppose the market doesn't really believe it either.
Yeah, indeed.
Yeah, in naphtha neither. No movement on that side.
Okay, so let's dive in a little bit into the individual products. James, maybe we start with you on the distillate side. Where do you want to start?
Yeah, sure. Well, I was on the podcast 2 weeks ago, and I guess we had like a kind of mildly bullish feel about distillate from then. And it's kind of panned out probably more in the cracks, particularly, ice gas oil, heating oil cracks, jet cracks as well, actually, to be fair. We've had some strength has been lent by kind of continued or extra fears about the Red Sea, the Houthi attacks, etc. But most of the kind of real macro fears around the tariffs, I think, have kind of subsided. As Neil was kind of to speak about, there's April 2nd coming up, but I guess the feeling is it's unlikely to affect distillates too much. In fairness, though, spreads have been relatively flat over probably the last fortnight, but do remain backward until kind of Q3 everywhere. Actually, backward in Asia all the way down the curve. So now we've got the US Gulf Transatlantic diesel ARB pretty firmly shut. We've seen the HOGO rebounding over the last week or so. We've seen, they were kind of flat today, the US stats, but over the last fortnight, they've been US distillate stocks have been drawing pretty hard. We've seen unseasonal outages in PAD 5, PAD 1, for example. Added to this, we've also had like high TC14 transatlantic MR freights increasing over the last period of time. I guess that's a kind of reaction to increasing US crude runs. We've seen also, I think, a narrowing US Gulf diesel diff. I think that's reflective of the kind of the drawing distillate stocks we spoke about before. And when we talk about like ARBs into Europe, really, it's only really like Red Sea ARBs and East Coast Canada ARBs, which are relatively small, that are open into Europe, and also only really in the very prompt. So we've had like gas oil and jet spreads generally widen further over probably the last month. But actually, interestingly, over the last probably week or so, we've seen the gas oil east-west has actually narrowed a little bit. And despite this general widening, kind of these diesel ARBs from the Middle East generally still get better ARB margins heading east than they do into west into Europe. So those two factors, reduced US Gulf exports to Europe, reduced or limited exports from the Middle East into Europe, is kind of two of the kind of three most important factors why I remain bullish distillate in general. I mean, added to that is the ongoing turnarounds in Northwest Europe and East Asia as well.
Yep.
But I kind of do want to just say that, the flows through the Suez Canal currently do kind of look generally quite stable, have been kind of increasing since November. But again, it's kind of those, I think an important point I want to be looking at over the next few weeks is kind of the kind of end of turnarounds in both Europe and East Asia. I think that's going to be like a real turning point. I'm going to carry on. So Chinese exports, I think as well, has been like a really important thing in the distillate market, probably since the end of last summer. And we've got the state operated enterprise of refineries going into maintenance now as well. So that's probably lending a bit of strength in the East as well. And that's why it's, I think, in backward all the way down the curve. And I think also another bullish factor is something that Neil was speaking about earlier, was also these Venezuelan sanctions as well. That's going to really be the biggest effect possibly on Chinese distillate exports as well, and their runs, essentially. So I guess, moving forward, I've kind of really said it, so I'm just going to repeat it really. But I'm still generally bullish global distillate cracks in the short to medium term. Margins in Asia, I think, look too weak. There's a risk to heavy crude. We've spoken about Venezuela, etc. That's rising as well. And I guess I still have that kind of same view on spreads as well. But I guess when I look at the diffs, for example, in Europe, it seems to be that the tightness in Europe tends to be more in the cargo market than ARA. So maybe we won't see such a big reaction in spreads, as it were. Yeah, that's how I feel, really.
Yeah.
James, just to do like a bit of a post-mortem, I think we said 2 weeks ago that we should be buying distillate dips and distillate cracks and flat price, just on the basis of something that Felipe mentioned right at the start of this, which was inventories are not high. And, 2 weeks ago, we had this uber macro signal. Everybody was afraid of what the tariffs were doing. And we were saying, well, nothing's happened to demand yet, and it might not for a few months. And so you should kind of buy cracks. And I think it kind of worked out in our favor, just to sort of pat ourselves on the back in a
that's great. Yeah, no, definitely. We've definitely seen the bounce in Western cracks. And even to be fair, Singapore diesel cracks and jet cracks have found at least a floor. So, well done, all of us.
Absolutely, we're the best. No.
No, but it's also just that
it sounded so. No, but I love the. I love how you said it. It was like, well done.
But it's also just about risk, right? Where's the risk and what's the timing? So the risk equities were like over early March, we're telling you about the long-term risk of demand kind of thing, and all the while there's all kinds of risk in the short term, like geopolitical risk at Suez, risk of refineries shutting down and closing, and all kinds of stuff. So it was kind of a different timing situation that we were talking about, right?
And again, I sometimes bring this up in the fundamental conversation, but there's the trading psychology. Okay, if every single analyst is telling you that the market is oversupplied, that it's going to go down, that it's like a subdued market, you don't want to get too bullish, especially when you just come out from a year where it was not easy. Crude, distillate, some people lost money. No one wants to take unnecessary risk. You have all these sanctions and tariffs and noise, and you don't know what to do and all that. So let's face it, most traders want to make money on the upside. So they're, bullish. Generally you don't have a lot of people that are, well, you have the perma bears, that's for sure, but it's generally you make money on the upside. But in this psychological environment, you don't want to make too much, you take some longs and then you get out as soon as possible because there's this sort of like pending bearish scenario.
Yeah, sentiment. Yeah.
But the thing is that we keep rolling, and that sentiment is just a sentiment. The stocks are not that high. We don't look at the structure of the market. We don't have max contango or anything like that. There's pretty. If you look at historicals of spreads and cracks, and I haven't. I don't look at the market every day, but when I look at it, they're generally within the sort of 10-year averages. In a lot of things. So.
Yeah.
So there's a psychological element there where you're like, I don't want to take too much risk. There's uncertainty, there's a lot of noise, but frankly, it's not that bad. It's not bad at all. And I would not be surprised that you do have some, if we do start seeing some potential hiccups in terms of supply, refinery here and there, it could be a good summer.
Yeah.
Indeed, yes.
And
I guess I would say, yeah, well, there have been some shocks that have affected the distillate market. But I guess if I had to summarize how we got to where we are with distillates is mostly due to poor refinery margins in Q3 last year. We started the year, we didn't build enough stock because of those poor refinery margins. We saw run cuts in Europe and Asia. And I think that's rolled on to now. That's mostly why we have low stocks in distillate now as well. Added to that has been colder than the last 2 years winter as well. That's been the main, I think. That's been the macro story.
Yeah.
What would you think? What would you say to that, Neil?
Yeah, one to add that you talked about earlier was just that China is not exporting nearly where it used to 18 months ago. I think that the timing's right there, but a few quarters ago, let's say.
Well, thanks
moving on to light ends, Jorge. Should we start with on the east of Suez? Let's go east to west. What can you tell us about what's happening in Asia?
Yeah, I think we have some changes compared to what we've been talking in market commentaries on podcast. I think in the general market, so good to go in all the three regions. But let's start with the east of Suez. What we have seen during this week have been some improvement on the ARBs, especially to Mexico and US West Coast. Last week we talked about US Gulf Coast being more competitive. Right now, this week is Singapore is the cheapest option as per our ARBs calculator. And looking at the Singapore 92 market, it has been very strong during the last, almost since the beginning of the year. And looking at this West, we started the year looking at April values, but we started the year in historical lows, and we are close to the average, almost in the historical average right now. So the market has been strong on the eastern side, and these new ARBs point in the same direction, together with lower supply expected in the short term from the refineries. And on top of that, I would like to mention also the Venezuela sanctions or tariffs and its impact in the eastern market for gasoline. We've talked about it's like a 5%, 0.5% of China imports, so it's not a very, very big deal. But it could, together with the sanctions on teapots, it could also strengthen the Singapore 92 and the eastern market of the gasoline. But I don't think it will be one of the big drivers. I think on the ARBs and on the supply side will be key for this Western Singapore. And if you want, we can move on to the west.
Let's move on.
Okay. Yeah. So the main thing I would say about this week, we've been talking about the ARB open from in the prompt from Europe to ARA to PAD 1. Right now, as per our calculation, is close, but it's very close to flat. So not a very big drop for blenders, but it keeps open for refiners. So not a big change on that. Maybe, freight has been rising, TC2. So the margin is a little bit worse, but I don't think it will have a massive impact in the outlook for the arbitrage. And what is more relevant is the margin for blending E10 locally in Europe. So as a blender, going to the market, buying the spot components, blend it and sell it on the window. It has been open during the last days, and the main reason is that components have kept decreasing. We have seen a very strong downtrend on almost all the components for the last month, and right now this can add some support to the component prices because more demand is expected locally, but it can provide a ceiling to the IPOP spreads that has been rising during the last weeks. Yeah, and on top of that,
where are the spreads now on gasoline? Where are they now? The April, May, for instance.
April, May minus 1.25.
Okay, so it's still in contango now. Okay, so
still in contango, close to backwardation, but still in contango. Yeah, and they come from -3 beginning of last week, something like that. So we have seen a small recovery since the ARB has been open to New York Harbor. Some opportunities last week in the Atlantic Basin, but right now, I would say there are less reason to be bullish on IBOP in the short term. I think in the medium term it keeps supported.
Interesting. I mean, maybe it's also a function, one of the reasons why you had this not TC, sorry, the ARB opening was the potential tariffs, Canada and all that. So obviously the next cheapest source was Europe. Maybe that's linked to that, something to monitor. But overall, the sentiment I would say is not as bad. We got into we got into the summer with we're full, the tanks are full, and all these things. But now it's not. That's although I say that, but you're saying that the component prices keep coming off.
Yeah, but that's what we've seen this week. But right now that the E10 blend margin is open in Europe, it should add some support to their demand.
Yeah, I don't see it that way. I see the other way around. For me, that's more of a bearish. If the E10 margins are open, then everyone is going to be blending E10. Is it the same thing for E5 or not?
Not for E5. It's not open yet.
No, okay. But that's that's it's as you said, it's more like a ceiling. That for that potential. Okay, yeah, it's still okay. Let's face it, it's not neither bull or bear story going on right now. It's just waiting momentum. Kick the can down the road. Fair enough. Naphtha, is it a more exciting story on naphtha or not?
I think in naphtha the market is quite interesting right now. We've been talking about the ARB open to the east. Right now it's more open. The cash diffs have kept rising in the east. In the last month we have gone from +2, +4 to +20. So it's a very big change. At the same time, we have seen a correction on the east-west and on time spread on cracks. So I think there are two different behaviors clearly on the market. One on the physical side and the other one on the paper. Yeah, I think that's the main part on the naphtha market right now. And we've maintained a slightly bearish position on paper, but right now I think that right now that the ARB is that open. And we have seen the first rebound in European cash diffs in Northwest Europe. So that means Europe want to fight for their supply as well and not allow it go easily to the east. I think right now we have more reasons to think about a bottom in the current downtrend on time spread on cracks.
Okay. Any trade recommendations, any ideas that you would suggest?
Well, as I said, on time spread for IBOP, we keep a strong view on the midterm, but maybe in the short term, this factor could take us to a ceiling. Then on naphtha time spread on cracks, I think we could see a bottom to the current downtrend because of the ARBs being very, very open to the east. And then we have the European component. I think we can find a floor, but you think the opposite. So let's see in the
No. Sorry, maybe I misunderstood, or what I said is that it's that the E10 it has a ceiling. It's like because of the components getting cheaper, then obviously you're going to be incentivized to blend. So we said we have the same view. I didn't say that the right way. Sorry. No. Okay. That sounds clear. And Gulf Coast seems pretty positive, no? I would say on a relative basis to if you're looking to trade relative, seems like the most bullish one of all of these right now, no?
Yeah, the stocks we have seen that the latest data a couple hours ago, they are close to the average in path 1 and path 3, but US Gulf Coast is going to start Q2 with very strong ARB opportunities in the Atlantic Basin. So I think that would be we are I think more bullish on that market than bearish. Yeah.
Very clear. And hopefully we also have a good job next week. Sorry, I'm messing with you, James. Physical crude. Neil, what's going on?
Yeah. So, okay, I've got two kind of things on my mind, I suppose. The one we've talked about a couple of times before, and I still sort of believe it. So the main thing being talked about in the market is the fact that WTI is not clearing very well to Asia. We've talked about that for 2 weeks or 1 or 2 weeks. And there's a couple of things that's causing this, right? So there's Asian turnarounds, there's probably a bit of weaker margin signal, and there's a couple of one-off things. So China has tariffed TI, basically. That's 200 KBD. That's 3-4 VLCCs a month. And there's this new Exxon resid upgrader project in Singapore, which just turned on. And we think that is about the same size of impact. That's 3-4 VLCCs of TI a month. So it starts to get quite a lot, all told. And most people are saying TI flows to Asia look very weak. And that's a problem. So TI is trying to clear against Murban in Asia, or even more. It's like a race to the bottom. And the issue there now is, in doing that, it's still landing really cheap in Northwest Europe. And what I was saying last week is I think I'm on the ARB basis, let's say, take out geopolitics. I'm bearish North Sea, I'm bearish ICE Brent spreads, because it's quite an unusual situation where TI is not clearing to Asia and it's cheap in Europe. And the sort of nuance the last couple of days is there's been this big spike on TT25. So I think that's partially evidence that TI is kind of getting dumped into Europe. It might also be because there's a relative lack of VLCC, so it's pushing stuff onto the Afras. But I think it sort of makes sense to me that, TI is going to flood Europe, and that's going to have an impact. It needs to close off that ARB eventually. And so TI Brent paper, which is now -4 for May, will eventually have to get squeezed. So I still think that if it wasn't for geopolitics, I would say that's the clear trade. But obviously at the moment, spreads have absolutely rocketed because flat price is up $4 in a couple of days. Now, the one thing to talk about on top of that is we've now had 3 consecutive weekly draws on Cushing stocks. Obviously, that's the price point for NYMEX TI. And we're starting to get stock levels back to 20 million barrels, which is the kind of red alert zone for commercial minimums. So if we see another one of those, that for me means you can't solve this thing through NYMEX spreads. It has to be this correction in ICE Brent. So I still think I'm heading in the same direction in terms of a correction in North Sea. It just maybe needs the right entry point, because at the moment geopolitics is at the fore. The second thing is I'm growing more bullish on the sour crude market. So we've talked about Venezuela. That would be huge if China really stopped buying and supply was just dropped. But there's also incremental demand all over the place. So we've talked about Exxon's resid upgrader. They'll probably take more sours as a result instead of sweets. There's various WAF kind of supply issues at the moment, one of them being Bonnie Light, where there's been a pipeline explosion. I think that was a sabotage type job. And there's a couple of kind of geopolitical things going on related to what we talked about earlier. Tupras is buying Guyanan instead of Russian grades. That's quite high volume. And there was also another one this week. So talking about energy security, the Druzhba pipeline, which is still providing Czechia with crude, has experienced some unexplained outages, let's say, the last few days. And so Orlen is in the market to try and replace some of these volumes via the TAL pipeline, which runs from Trieste. And reportedly, they're buying Johan Sverdrup and things like that. So that's keeping JS supported. So all these things are coming together. And I just think there's a growing list of bullish cases for sour crude and therefore the EFS. So like all kinds of fits in my mind in the same direction. Bid up the Dubai market, you short the Brent market. And just to say, it's not all plain sailing. So there's a few other things happening. We've talked about Russian crude flows, very strong at the moment. I guess that's temporary. I'm not sure. OPEC are lifting supply by 100, 120, though there's also compensation cuts, so you have to decide what happens there. And there's some new startups, one from Norway called Johan Castberg, which is a nice medium crude. So that's
is that the other Johan's cousin, or
exactly? I think it is. It's the pair of Johans.
Sorry, very bad joke.
No. So
you can kick me out of the pod if you want. Sorry.
We can AI that out.
James is gone.
James left.
He left the conversation.
No, I'm back.
No, but just to wrap that up then, just because I've been talking too long. So bullish showers, bullish Dubai, all told, bearish EFS, bearish Brent, and I suppose at some stage TI Brent needs to be squeezed. Yeah, that's it.
Okay, well, that's it for us. It's been a good, very interesting pod. Thanks a lot, guys.
Thanks, you too.
And I'll speak to you guys next week. Take care.
Thank you very much.
Thank you.
Cheers.
Bye-bye.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.